Hello everyone, and welcome to the Market Compass. Markets remain on edge as the Iran conflict continues, with stocks moving in the opposite direction of oil prices. Recent attacks on Middle East energy infrastructure triggered the first 5% pullback in the S&P 500 this year, highlighting how sensitive investors are to rising geopolitical risks. At the center of this story is a simple question: how long will the disruption last? Higher oil prices are clearly a headwind, but the economic and market impact will depend less on the initial spike and more on how persistent it proves to be. Let's start by zooming out to look at the backdrop. Higher energy prices act like a tax on consumers. Every additional dollar spent at the pump is a dollar not spent elsewhere. At the same time, higher energy prices would push headline inflation higher and complicate the outlook for central banks. So yes, the headwinds are real, but it's also important to keep perspective. In our view, this is not a 1970s style energy crisis. And there are a few reasons for that. First, energy is a much smaller set of household spending than it used to be, with it being roughly 2% today versus about 6% back then. Second, the US is far more insulated from a supply perspective than it was in the past decades, as it has been a net exporter of oil since 2019. And third, today's economy is much less energy intensive overall, with services making up a far larger share of output than they did during the 1970s. In other words, oil still matters, but it matters less than it used to. That doesn't mean markets should ignore the shock. It just means that today's economy is entering this period from a more resilient starting point. To help frame the uncertainty, we're thinking about three scenarios. Our baseline scenario is for a sharp but short-lived spike. In this case, West Texas Intermediate oil trades in roughly $90 to $100 range before moderating back towards $70 to $80 by year-end. Energy flows remain constrained through at least part of the second quarter, but gradually improve after that. Under this outcome, inflation moves somewhat higher in the near term, growth slows, potentially below trend, and the Federal Reserve still delivers one rate cut later this year. Treasury yields remain range-bound and US equities hold up relatively well. Now, in our downside scenario, oil rises to $120 or higher and stays elevated for several months. Growth slows more meaningfully, the Fed likely stays on hold this year, and the S&P could see a correction of 5 to 15%. In our best-case scenario, the conflict de-escalates quickly. Oil falls back towards $70, inflation pressures prove temporary, and the Fed can cut rates twice in the second half of the year. That would likely support a rally in stocks, especially in more cyclical areas of the market. Now, let's turn to the Fed. The Federal Reserve is clearly in a difficult position. It must balance downside risks to the labor market against upside risks to inflation. This month, the Fed left rates unchanged and emphasized the uncertainty surrounding developments in the Middle East. Importantly, it did not signal that the next move could be a hike. In our view, that suggests policymakers are still willing to look through a one-time energy-driven increase in inflation, at least for now. The key variable to watch from here is inflation expectations. So far, the rise appears concentrated in shorter-term measures, while longer-term expectations remain relatively well anchored. If that continues and if the conflict proves short-lived, the broader disinflation trend should eventually resume. So, what does all this mean for investors? Our view is that while volatility may stay elevated, stronger fundamentals should provide a cushion. Consumers still have more income than they did in prior oil shocks. Household debt burdens remain manageable. Unemployment is still low by historical standards, and ongoing AI-related investment continues to support growth. From a portfolio perspective, if oil prices remain elevated, the energy sector, US large caps, and technology may offer relative resilience. If the disruption proves short-lived, leadership could broaden to include small caps, value, and international equities. In fixed income, inflation concerns may keep yields volatile in the near term. But if the 10-year Treasury yield moves closer to 4.5%, we would view that as an opportunity to consider intermediate and long-term bonds and lock in higher yields. The bottom line is this: the current oil shock is a real risk for growth, inflation, and markets, but it is not necessarily a recession story. For now, the duration of the conflict remains the key variable, both for the Fed and for investors. Bouts of volatility may create opportunities to rebalance portfolios, strengthen diversification, and add high-quality investments at more attractive valuations. For tailored advice for your specific situation, connect with your financial advisor. Thanks for watching, and we look forward to seeing you next month for the Market Compass.